Welcome to the Three Edge Weekend Review for the week of May 9th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today, once again, is Steve Cucchiaro, CEO and Chief Investment Officer at Three Edge Asset Management. Today, Steve and I will be discussing the dramatic declines in the equity markets thus far in 2022 and examine whether we are in fact in a bear market, how bear markets may typically behave, and if we are in a bear market, how long could it last? First, a brief look at recent market activity. And this past week, the financial news certainly revolved around the Bureau of Labor Statistics report on the Consumer Price Index for April, which is a key measure of inflation. And it came in at 8.3% year over year, which was a bit below the previous month, but above the consensus estimate. And frankly, still, that's an extraordinarily high number. And this had investors worrying that inflation could remain elevated for an extended period, and equity markets have continued to grind lower. And what I might describe as a case of overvalued markets colliding with inflation and commensurate tightening of the Fed's monetary policy. The quandary, of course, for the Fed is can it tame inflation by reducing demand without pushing the economy into recession? And the answer at this point certainly is it won't be easy. So, Steve, as we know, 2022 has been a difficult year so far for both stocks and bonds. Year to date, the S&P is down in the mid-teens. The NASDAQ is in the mid-20s in terms of its decline. And in terms of defining a bear market, there is a sort of a fairly standard, albeit arbitrary definition of a bear market, which is a decline of 20% or more from a recent peak. So I guess by that measure, the NASDAQ has entered bear market territory. The S&P is certainly closing in on a decline of 20%, perhaps. But standard definitions aside, how would you define a bear market? And understanding that all bear markets are, of course, different, but in general, how might you describe typical bear market behavior?
Well, you're right, Fritz. Most people define a bear market by a decline of 20% or more. But there are good examples of bear market declines over 40%, over 50%, even over 80%. In the Great Depression, we had two major dips. The first one, stock market fell over 80%. The second one, over 50%. From 72 to 74, we had a very grinding, prolonged bear market, lasted almost 2 years and fell over 40%. The Japanese stock market peaked at the end of 1989 and went down for 9 years and fell more than 80% at its worst point. And then, of course, we have the tech stock bubble that burst. The NASDAQ 100 index peaked in March of 2000 and fell over 80% until it bottomed in September of 2002.
Right.
So the bear market experience, there are many examples over time. There are a lot of younger investors, retail investors, that have never experienced a true prolonged bear market and only have seen a bull market. And we know that, as they say, bull markets climb a wall of worry. But you can say for bear markets, they slide down a river of hope. And what I mean by that is that in a bear market, and this is different than a crash that happens in 1 or 2 days, but in a bear market, it's a long, prolonged decline, but interrupted with some very strong rallies. And each time there's a rally, there's this thought that the bear market is over, we can sigh relief again, time to get back in the market, only to be punished again as the bear market continues. And one good example of that, in the tech stock bubble burst, where the NASDAQ 100 fell over 80%, during that period of time, there were 16 bear market rallies, each of which was over 10%. So there's just plenty of opportunity to be fooled and think it's over, only to be prolonged.
Wow. So, all right, in terms of definitions of bear markets, my takeaway this week is you may know you're in a bear market when you start to see quotes everywhere from pundits about bear markets. But two that I quite like. One is from Louis Gove, who we know well as a very well-respected sort of market analyst, and he said that bear markets don't end because we want them to. Something has to happen to change investor sentiment. And then another quick quote that I saw this week that I liked was he said that this, actually, I don't know who said this one, but the quote is, bear markets only end when everyone who wants to or needs to sell has sold. And actually, if we go by those two measures, and we are in a bear market, neither of those conditions has been satisfied yet. So anyway, as we know, the markets are too complex for anyone to know with certainty what's going to happen next. However, assuming that we are in fact experiencing a bear market, how long might we expect it to last? And what clues might our three-edge research model provide us, which would indicate that perhaps the bear market has run its course?
Well, you can think of all the time and energy and effort we've spent building and experimenting with our models and doing our research. It's exactly for times like this to try to provide some more scientific, rigorous guidance as to how long a bear market can last and what are the signposts. And in going back to the end of 2021, stock market was hitting new all-time records, and yet our models are already indicating it was time to worry. And we formed a hypothesis right at the turn of the year and made some changes in the investments to get more defensive, because we were worried that perhaps, and had a thesis that the bear market could have peaked, the bull market could have peaked the turn of the year, and a new bear market might have started. So what do we see? Number one, we saw extreme overvaluation, which still exists today, even despite the fact that the market is down quite a bit from its peak. Some people look at PE ratios and say, well, the market's not that overvalued. It's a little bit overvalued. But we like to point out that PE ratios can be very misleading at turning points, and especially when you have record profit margins. When you go back to a more normal profit margin, or you look at the price to sales ratio, which is a better long-term indicator, you see that we're still extremely overvalued. We looked at the end of the Fed stimulus, believing in our model showing that a big reason why we had these asset bubbles was the extraordinary Fed stimulus. We looked at the beginning of widening credit spreads, beginning of the flattening of the yield curves. And so our hypothesis so far is proven accurate. And everything that's happened since the beginning of the year is consistent with the idea that we are in a bear market. Now, what could be the catalyst that turns things around, or the end? Well, certainly, one way that we could start to rebound and go back into a bull market is if the Federal Reserve Board capitulates. And over the last decade, anytime the market fell about 20%, which is the definition by many of a bear market, the Fed capitulated. They changed course. They stopped raising rates. They started lower rates. And off to the races the markets went. And people learn that kind of buy the dip behavior based on counting on the Fed to always come in to rescue. This time, unlike before, we now have an inflation problem. We have an administration who's saying, I don't care about the stock market. I care about inflation. Do what it takes to fight inflation. And we know that it's going to take many more rate hikes, because typically you don't really get inflation to reverse course until you drive interest rates above the CPI. And we know the CPI is far above where interest rates are now. So it's hard to know exactly what the Fed's going to do, because they haven't made their decisions yet. But if we go based on what they've said more recently, they're going to continue to fight inflation. So then we look at valuations, and often a bear market doesn't end until you at least get back to fair value. And in many cases, you overshoot to undervalue. And by all the different ways we measure valuation, looking at different scenarios for discount rates, in every case, fair value is below 3,000 on the S&P, which is still far below where we are today. So we say that the bear market has the potential to go quite a bit further than where we've seen already. Another measure to confirm if you remain in a bear market or if you've crossed over to a new bull market has to do more with investor psychology. It's tied around this idea of the 200-day moving average. And if we saw how the bull market acted over the last decade. Generally speaking, the market wouldn't go up every day, but when it dipped, it would never dip below its 200-day moving average, which is roughly equivalent to the last 10 months of trading days. In a bear markets typically will fall below the 200-day moving average, and then you get these bear market rallies that might come up to the 200-day moving average and then fall again. And that's a very typical sign of a prolonged bear market. And right now, the 200-day average of the S&P is a little bit below 4,500, so that would allow for a pretty strong bear market rally. And then if that falters and we keep going down, that would have proved to be a good time to lighten up even more if you hadn't done so already. So if it does break decisively through, say, 4,500, that's a sign that maybe the bear market is over and we're off to a bull market again.
Excellent. So as always, my final question is, based on what we've discussed here today about bear markets, how would you recommend investors position their portfolios in the current environment? And then sort of one, I guess, caveat to that is that investors also need to consider the fact that, well, both their stock and bond portfolios could have declined, materially in this correction. And so keeping that in mind, how do we think about being positioned going forward from here?
Well, to be honest, the duration of the bear market and the depth of the bear market does depend on decisions that have yet to be made.
Right.
So we talked about the Fed as an example. Depending on how their decision making unfolds, will have a big role in deciding how long the bear market continues. Now, because of that, because it's not 100% guaranteed what's going to happen, we would still advocate investors staying diversified across several asset classes. However, certainly all the science would support and all of our evidence and our research would support being on the defensive side. And if you have a range of equity allocation that's appropriate for your risk profile, we would certainly advocate being closer to the lower end of that range.
Right.
For example. Now, when it comes to real assets, we know that inflation could be more embedded. It could take quite a while for the Fed to ever get on top of the inflation curve, and how many hikes will it take before inflation starts to come down again? It depends on things like how prolonged the Ukrainian war lasts, et cetera. And also now we're seeing inflation embedded in services as well. So it could be more prolonged. And the more investors are convinced that the Fed's going to fight and beat inflation, then that could constrain real assets. So we don't want to be at our maximum real assets, but there's a healthy chance that the Fed is so far behind the curve that real assets continue to appreciate. So we certainly want an allocation to real assets. Mm-hmm. It's either at a midpoint of a range or a bit above. When it comes to fixed income, of course, it's really paid to be in the safest form of fixed income, which are U.S. Treasuries, not to take credit risk, and to be generally in the lower duration range, and also include inflation protection through TIPS. So, and then finally, we think this is a great time to have an allocation to cash or equivalents, which can be in the form of floating rate treasuries or very short-term treasury bills, because you want to have the option that in the future, if this bear market continues and we get to much lower prices, you want to have the opportunity to be buying when the market is undervalued at the same time during panic selling is occurring and when people are finally capitulating and giving up. So that's how I would describe our approach and how investors should really think about their own asset allocation.
Excellent. Great. Thank you. Thank you very much. That was really a very comprehensive explanation of, a very uncertain time. So in closing, the one thing that I kept thinking about when I was preparing for this video was how it wasn't that long ago when, markets pundits were saying, we're asking, can the Fed ever get the inflation to their target of 2%. And yet, not that wasn't not that long ago, and yet here we are. So I guess that's what makes markets.
Be
So that
careful
will
what you wish for.
Steve, that will do it for us. Remember, all our videos are always available on our YouTube channel. And in addition, all our videos and commentaries are always available on our website, and that's 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.